So here's the big question we're tackling today. Is Meta Platforms, the company connecting almost half the planet, actually building the next internet with all this AI and metaverse spending?
Mhm.
Or could this be one of the most expensive corporate blunders in history? Right now, the market seems to think they're balancing it okay. Welcome to this deep dive into Meta Platforms, Inc. That's NASDAQ ticker Meta. Just so you know, all the data we're using is current as of July 4th, 2025, and we're using the closing share price from July 2nd, which was $713.28.
Right. And our goal here is really to look at Meta like a value investor would. We're digging into, the actual quality of the business, how competent the management seems, and trying to figure out what its long-term intrinsic value might really be.
And we've split this analysis into two parts for you. Today's part one, and we're covering the first three chapters: business analysis, management evaluation, and financial analysis. All right, let's kick things off with chapter one, business analysis. Okay, first things first. To get Meta, you have to understand its core. It really is fundamentally an advertising company. I mean, it's not just part of business, it's pretty much everything. Still, in 2025, something like 98% of their total revenue comes from ads. Just look at Q1 2025, what was it? $41.39 billion from ads out of $42.31 billion total. It's staggering.
It absolutely is. And that revenue machine is basically run through two main segments. First, you've got the family of apps, or FOA. This is the engine. Facebook, Instagram, Messenger, WhatsApp, Threads. They're all in there. FOA brought in $41.90 billion in Q1 25.
Yeah.
So basically all the income. Then the other side is Reality Labs, RL. This is the big, ambitious, long-term play. The Metaverse, VR, AR hardware, software, think MetaQuest, Horizon Worlds. But right now, RL is a huge cost center. It only made about $412 million in revenue in Q1, but the operating losses are in the multi-billions, and that's the core tension, right? FOA's massive profits are funding this enormous and honestly still unproven bet on RL. That 98% ad dependency shows dominance, sure, but it's also a huge concentration risk. And that's what RL and the AI investments are supposed to help diversify away from eventually.
So the family of apps products, Facebook, Insta, WhatsApp, Threads competing with X, Reels for video, that's the user experience and ad delivery system today. And Reality Labs is MetaQuest, Horizon Worlds, and this big push into AI smart glasses with Ray-Ban and Oakley.
Exactly. And what's really interesting now is how artificial intelligence is kind of the glue between these two worlds. It's becoming a central pillar. They're pouring money into their own large language models, like Llama. They're even planning paid access for businesses. And at the same time, AI is getting woven into everything else. You've got Advantage Plus for advertisers, using AI to optimize campaigns, which is crucial with all the privacy changes. And for users, there's the Meta AI assistant popping up in the app. So it's this two-pronged approach. Use AI to make the ad business even more profitable, and use those profits to fund the next generation of AI-powered hardware. It's quite clever, really.
And the scale is just hard to wrap your head around. Sixth most valuable company globally, market cap around $1.8 trillion. But the user numbers are the real story. 3.98 billion monthly active people, MAP. Almost half the world using a Meta product each month. And the engagement. 3.35 billion daily active people, DAP. That's 84% of monthly users showing up every single day. That's just unparalleled.
Right, and that scale drives their value proposition. It's twofold. For users, it's free tools, right? Connecting, communicating, entertainment, expressing yourself on Facebook, Instagram, WhatsApp, Reels. For advertisers, it's that massive reach, plus incredibly sophisticated AI-driven targeting tools and analytics like their brand lift study to show real ROI. They're essentially selling user attention very, very efficiently, and their value comes down to how well they can keep making that match.
Okay, let's unpack this a bit more. And hey, if you're enjoying this deep dive and want more stock analysis like this, please do like and subscribe to the Stock Analytics AI YouTube channel. It really helps us out. Right, let's move into industry analysis. Starting with market trends and growth potential, the digital ad market itself is still growing strong. It's projected to hit almost, $1.5 trillion by 2034. That's like a 9.5% compound annual growth rate. So a nice tailwind for Meta.
Definitely. And within that market, there are a few key trends Meta's riding. First, video is king. Digital video is grabbing nearly 60% of US ad spend in 2025, especially short-form stuff like Reels. Second, the AI revolution. It's changing everything in marketing: hyper-personalization, automated campaigns. Meta's right in the middle of that. And third, the metaverse opportunity. Okay, it's super speculative, massively speculative, but the potential numbers are huge. Some forecasts go from maybe $156 billion in 2025 to over $4.7 trillion by 2034. That's a crazy 46% CAGR. That potential, however uncertain, is the justification for the massive RL spend. So Meta's actually positioned pretty well for all three trends. Their future growth really depends on how well they execute on video, maintain AI leadership, and actually make progress on this whole metaverse thing.
But they're definitely not alone. You described it as a multi-front war, right? Against huge players in ads, messaging, e-commerce, computing. You've got Google, obviously, their duopoly partner. Amazon's becoming a huge third force in ads. TikTok is a direct threat, especially with younger users, and the engagement is really high there. Snap Inc. is still around. And then on the hardware front, Apple with Vision Pro, Microsoft with HoloLens.
And the TikTok point is critical. ByteDance, their parent company, is reportedly targeting $186 billion in revenue in 2025. That's almost identical to Meta's projection of $187 billion. It's literally a dollar-for-dollar fight for ad budgets now. It's that direct.
Wow. Okay, let's turn to the regulatory environment. You said this is maybe the single biggest external threat.
I think arguably yes, especially for their data-driven model. Look at the EU's Digital Markets Act, the DMA. The ruling that Meta's payer consent model didn't comply was a big blow. It forces them to offer less personalized ads, and that could start hitting revenue noticeably by Q3 2025. And in the US, the pressure keeps mounting. There's the ongoing FTC antitrust lawsuit, remember? That could potentially force them to sell off Instagram and WhatsApp. Plus, you've got legislative efforts like the Kids Off Social Media Act, banning under 13s, restricting personalized algorithms for teens, and various state laws popping up too. It's coming from all angles.
Right, and you mentioned this connects back to their big AI push, like Advantage Plus way, trying to build tools that work well even with less user data off-platform.
Exactly. It's about building resilience, finding ways to deliver ad performance using on-platform signals and AI modeling, rather than relying so heavily on tracking users across the web, which is getting harder and harder.
Okay, so what about new competitors? What are the barriers to entry? Is a Facebook killer even possible anymore? It's nearly insurmountable for a direct competitor today, I'd say. First, the capital requirements. Meta's planning to spend, what, $64 to $72 billion on CapEx in 2025 alone, mostly on AI data centers. No startup can come close to that kind of spending. Then you have the network effects. With almost 4 billion users, the value for each user increases as more people join. Your friends are there, your family's there. It's the default social layer for much of the world. That's an incredibly powerful moat. And finally, switching costs. They aren't really financial, but they're high socially. You lose your connections, your photos, your history. It's a big deterrent. So yeah, a direct Facebook killer seems highly unlikely. Which is precisely why Meta is investing so aggressively in the metaverse. It's defensive, to avoid being disrupted and offensive, to try and own the next big platform shift.
Which leads us nicely into Meta's competitive advantages. Its moat. We've touched on some, but let's list them out. Obviously, brand strength and recognition. Facebook, Instagram, WhatsApp. These are household names globally. Analysts often rate them as top picks, reinforcing that brand power.
Then there are huge cost advantages and economies of scale. Spreading those massive fixed costs R&D infrastructure across billions of users makes the cost per user incredibly low. And that huge CapEx isn't just spending, it's building a proprietary global infrastructure that gives them a cost edge over anyone relying on, say, AWS or Google Cloud.
And we already mentioned network effects and switching costs. You said that's really the heart of Meta's moat.
Absolutely. It creates that stickiness and self-reinforcing growth. Hard to compete with that. And finally, they have unique assets and capabilities. The sheer volume and depth of their proprietary user data is unmatched. Their world-class AI, like the Llama models, turns that data into insights and product features. And historically, their proven acquisition capability buying Instagram, buying WhatsApp was a huge advantage, although, as we noted, regulation has really put the brakes on that now.
What's fascinating here is, well, we build our analysis based on what our community wants to see. Remember, members can add stock suggestions for future videos in the comments, and we will pick them up. Okay, let's move into Chapter 2, Management Evaluation. And you really have to start with Mark Zuckerberg, the Zuckerberg factor. Founder, chairman, CEO. He's clearly the visionary. Very data-driven, intensely focused on product, and known for prioritizing the long term.
Yes, all true. But his track record in managing crises, it often looks reactive, not proactive. Remember the 2018 Cambridge Analytica scandal? That involved improper data harvesting from, 87 million users? The response felt slow, kind of defensive initially, before Zuckerberg eventually apologized. It led to that massive $5 billion FTC fine and really damaged their reputation. And we see echoes of that pattern, like with the EU's DMA regulation. They initially complained about shifting goalposts before ultimately having to comply. It suggests regulatory and reputational risks are just an ongoing part of the Meta story under his leadership.
And And what about communication transparency and ethical reputation? They have the official policies, the code of conduct, transparency reports.
They do. But there's often a pretty significant gap between those stated principles and their public reputation, wouldn't you say? The ongoing data privacy issues, that huge 1.3 billion EU fine recently, it feeds the perception that the business model, which relies so heavily on user data, is inherently in conflict with the global movement towards greater privacy. It often feels like they prioritized business until regulators force their hand.
Okay, let's talk capital allocation. The great gamble on AI and the metaverse. You mentioned the pivot from big M&A because deals like buying the VR company Within got blocked towards massive internal R&D. And the spending numbers are just eye-watering. Projected capex between $64 billion and $72 billion in 2025 alone. Where's that actually going?
Right, it's enormous. And it's flowing mainly into two buckets. Artificial intelligence. A huge chunk is for building out the data center infrastructure needed for their AI roadmap, which directly boosts ad performance too. And the Metaverse. That's the Reality Labs division. It's the big swing. And it's already racked up something like $60 billion in operating losses since 2020. There are reports CTO Andrew Bosworth called 2025 a potential make-or-break year for RL, so the pressure is on. And this shift really changes the risk profile, doesn't it? It's less about maybe overpaying for an acquisition and more about the risk that these gigantic internal investments, especially in RL, just don't pay off.
But alongside that massive spending, there's this other narrative emerging, capital allocation. A new era of shareholder returns. Meta's maturing in some ways.
Exactly. The core business is such a cash cow that they can fund the moonshots and return series capital to shareholders now. Look at the share buybacks. $17.6 billion just in Q1 2025. Over the last year ending March 25, it was $43.4 billion. Huge numbers. And then the big signal. Initiating their first ever quarterly dividend in early 2024. They even increased it in February 25 to $2.10 per share annually. And critically, the payout ratio is super low, around 7.7%. That tells you the dividend is incredibly safe and there's tons of room for future growth, even with all the spending and buybacks.
Okay, and how does return on invested capital, ROIC, fit into this picture? You said their TTM ROIC ending March 31, 2025 was 29.13%, a new high. That sounds great, but how, with RL losing so much?
That's what makes it so revealing. Think about it. Reality Labs is this capital black hole, right? It's dragging returns down significantly. For the entire company to still achieve an ROIC of nearly 30%, it means the core family of apps segment must be generating truly astronomical returns on its invested capital. It just hammers home the incredible profitability and efficiency of that legacy advertising business. It's basically funding everything else.
All right, let's transition now to Chapter 3, Financial Analysis. Quick recap on key metrics. Market cap around $1.8 trillion, still one of the giants.
And looking at revenue and profitability trends, the story is resilience and then re-acceleration after that 2022 dip. Remember, that was tough comps post-COVID, plus Apple's privacy changes hitting them. But they bounced back strong. The numbers from 2020 to 2024 show total revenue going from about $86 billion to almost $165 billion. Revenue growth dipped negative in 2022, but shot back up to nearly 22% in 2024. Net income followed, hitting $62 billion in 2024. Diluted EPS was up to 24.61 cents, and free cash flow also recovered strongly to $52 billion in 2024.
And the profitability itself is just, wow. Gross profit margins consistently in the 80-82% range. Q1 2025 saw a 41% operating margin and a 39% net profit margin, even with those huge RL losses baked in.
Yeah, it's a prodigious generator of cash, as some might say. They pulled in $10.33 billion in free cash flow in Q1 2025 alone. Even with that massive capex plan for this year, analysts think they could still generate nearly $50 billion in FCF for the full year 2025. That's the kind of cash flow that lets you build the future and reward shareholders today.
Okay, let's look at financial stability, a fortress balance sheet.
It really is incredibly strong. Earnings consistency is there, and growing Q1 2025 EPS accelerated to $6.43. They use very little debt. The debt-to-equity ratio is tiny, just 0.16, minimal financial risk from leverage.
And liquidity looks good, too, with a current ratio of 2.66. Plenty of assets to cover short-term liabilities.
And dividend stability, while the dividend is new, looks rock solid. Given the massive FCF and that super low payout ratio, the probability of future growth seems very high.
So putting it all together, let's get into valuation analysis. What is Meta actually worth? Starting with relative valuation, their PE ratio is around 27-28 right now, July 2025. That's actually below their 10-year historical average, which is closer to 31. So not historically expensive on that metric.
Right. And compared to peers, It trades higher than Alphabet, Google's around a 20 PE, but lower than Amazon, which is up around 35. So the market seems to be pricing in strong growth, but maybe also baking in some discount for that metaverse execution risk compared to, say, Amazon's cloud dominance.
Okay, now for the intrinsic valuation using a discounted cash flow DCF analysis. And always the caveat, this is just an estimate, very sensitive to the inputs.
Absolutely. So for our educational model, we used a 10-year forecast period. We plugged in an FCF growth rate of 10% for the first 5 years. That feels conservative given recent growth, but accounts for scale and competition. Then a terminal growth rate of 3%, which is pretty standard, just above long-term inflation expectations, and a discount rate, WACC, of 9.0%, standard for large cap tech, but, tweak this number, and the valuation changes significantly. Based on those assumptions, the model spits out an estimated intrinsic value for Meta somewhere in the range of $680 to $790 per share.
Okay, and that wraps up part 1 of our Meta deep dive. Next time, we'll jump into part 2 that covers chapters 4 through 7, market sentiment, ownership structure, risk assessment, and then we'll pull it all together in the conclusion. Welcome back to the deep dive. We're now into part 2 of our analysis of Meta platforms. Let's kick off with chapter 4, market sentiment. So how is the market actually feeling about Meta? Looking at market perception, Wall Street seems pretty bullish, right? About 91% of analysts have it as a buy or strong buy.
Overwhelmingly positive on the surface, yeah.
Yeah.
But look closer at the analyst price targets. They're all over the place. The low end is down around $360 to maybe $525. The median seems to be clustering around $730, but the high end goes way up to $935. That wide range tells you there's still a healthy dose of uncertainty, particularly about Reality Labs and the long-term spending, even if they like the core business now.
Yeah, you see that split in recent analyst actions, too. You've got bullish firms like Citi and Baird raising targets to $803 and $740, citing AI and ad strength. But then you have Needham upgrading to hold, but still staying cautious precisely because of those huge CapEx increases. It's definitely not unanimous on the outlook.
And the media tone reflects that split, too. Financial news, mostly positive earnings beats, AI progress, cash flow. But political and tech policy reporting, often focused on the regulatory battles, the privacy issues, those ongoing Reality Labs losses, two different stories being told.
Okay, what about market indicators, technicals, and investor positioning?
Well, short interest is really low, only about 1.39% as of mid-June 2025. The peer average is much higher, like 8.6%, so very few big players are betting heavily against the stock right now.
Yeah, technically. The stock price around $713 is well above both its 50-day moving average, around $652, and its 200-day, around $629. That's generally seen as a strong bullish signal, suggesting a solid uptrend is in place. All right, let's move to Chapter 5, ownership structure. Starting with stakeholder analysis. Who's in control? We know institutions own a lot, right? About 79.3%. Big names like Vanguard, 8.5%, BlackRock, 7.2%. Fidelity, it's a core holding for many funds.
It is. But the single most important thing to understand about Meta's ownership is the dual-class share system. This is crucial. Mark Zuckerberg owns Class B shares. Each of those gets 10 votes compared to 1 vote for the Class A share the public holds. What that means is he personally controls over 61% of the total voting power. So Meta is what's called a controlled company. At the end of the day, all major strategic decisions like continuing to pour billions into the metaverse rest solely with him. Forget activist campaigns trying to force a spin-off or change strategy. It's not possible here.
So investors are really betting on Zuckerberg's long-term vision, whether they fully agree with it or not. What about insider holdings and recent transactions? Seeing lots of sales? Yeah, you do see sales sometimes by Zuckerberg via the Chan Zuckerberg Initiative Foundation. That's for their philanthropy and other executives too. But typically, these are pre-planned sales set up under what's called Rule 10b-5-1. It's a standard way for insiders to sell stock over time without being accused of trading on non-public info. So usually not a sign of bearishness in itself.
Right. So the takeaway on ownership concentration is pretty stark. Voting power is extremely concentrated with Zuckerberg. Economic interest, though, is spread among those large institutions.
Okay, on to Chapter 6, risk assessment. We like using a SWOT analysis here to frame things. Internal strengths and weaknesses, external opportunities, and threats. For strengths, market dominance, 4B users, super profitable ad business, at 41% up margin, fortress balance sheet, network effects, top-tier AML. Weaknesses, that heavy ad dependence, 98%, the damaged reputation we discussed, huge RL losses, and definite key person risk with Zuckerberg having all the control. opportunities. Growth in emerging markets still, the potential multi-trillion-dollar metaverse prize, maybe monetizing messaging platforms like WhatsApp better, commercializing AI models, and threats, intense competition, Google, Amazon, TikTok, Apple. Users may be shifting away, especially young people. That's severe and growing global regulatory pressure, DMA, FTC, macro headwinds, inflation, rates, and even geopolitical stuff like U.S.-China trade issues.
Let's maybe deep dive into a couple of those key threats. First, the impact of key macroeconomic factors. Inflation and interest rates. Inflation is pretty straightforward. It eats into consumer spending, which means advertisers might pull back budgets, hitting Meta's revenue. Interest rates are a bit more complex. Higher rates increase the discount rate used in valuation models. Since Meta's a growth stock, a lot of its value is tied to future cash flows. Higher rates make those future flows worth less today. So it's a double whammy, potentially less ad spend, and a lower valuation multiple.
Okay, and what about those specific geopolitical factors, like the U.S. tariffs mentioned for 2025? How does that hit Meta?
Well, it's kind of surprising, but a lot of Meta's recent ad growth actually came from Chinese e-commerce giants. Think Temu, Shein spending massively to reach U.S. consumers via Facebook and Instagram ads. Exactly. I mean, that business model relies heavily on things like the de minimis rule, which lets cheap packages come into the U.S. duty-free. If the U.S. imposes significant tariffs, say 10% or more, on Chinese goods and potentially gets rid of or changes that de minimis rule, suddenly that whole business model for Temu and Shein looks much less viable. The logical consequence, they'd likely slash their ad spending drastically. And since they became such big advertisers for Meta, that could create a sudden, significant revenue hole. It's a tricky sort of third-order risk that connects social media ads directly to global trade policy.
Wow, okay. That brings us to our final section, Chapter 7, Conclusion. Let's try to synthesize findings here. The bull case versus the bear case. The bull case seems clear. An incredibly dominant, hugely profitable core business in the family of apps. Nearly 4 billion users. Powerful network effects, high switching costs keeping users locked in, exceptional profit margins, that fortress balance sheet, management that has shown it can adapt and reaccelerate growth, clear leadership in AI now, and this new commitment to shareholder returns via dividends and buybacks. It's a cash machine.
Pretty compelling. But the bear case is also strong. Meta's fighting that multi-front war against tech giants. The regulatory pressure is intense, global, and seems to be escalating, directly targeting their core data advantage. Then there's the Metaverse gamble, over $60 billion sunk into Reality Labs already, with profitability maybe years away, if ever. That raises real questions about capital allocation discipline. Plus, the governance structure, all power resting with Zuckerberg, is both potential strength, long-term vision, and a major risk. Single point of failure, no checks. And finally, those macro and geopolitical risks we just talked about are very real and largely outside their control.
So wrapping up the valuation summary, our educational DCF, based on our specific assumptions, gave us that estimated intrinsic value range of $680 to $790 per share.
Right. So our concluding outlook as of early July 2025 is this. Meta's share price, sitting around $713.28, falls right smack in the middle of that estimated intrinsic value range. What that suggests is that the stock looks fairly valued right now. The market seems to be doing a decent job of balancing the undeniable quality and cash generation of the core ad business against the very real execution risks and massive costs tied to the long-term AI and metaverse ambitions. You could argue an investor today is paying a fair price for the existing, highly profitable business and getting the high-risk, potentially high-reward metaverse option at a reasonable, maybe not deeply discounted, but reasonable premium.
It really leaves you with this core tension, doesn't it? Meta is this dominant cash cow, funding a hugely ambitious, incredibly expensive, and still very uncertain future. Maybe the final question for you to think about is, how will Meta's unprecedented scale, combined with that singular leadership structure under Zuckerberg, navigate the next wave of disruption and regulation that's inevitably coming? And on that note, if you found this deep dive helpful, please do like and subscribe to Stock Analytics AI. Remember, our 4.999-month members get priority deep dives on tickers. We're planning to cover all of the S&P 500 stocks over the next few months, and members get exclusive priority access. Or if you just want a one-off deep dive on a specific stock you're interested in, dropping us a super thanks is a great way to request it.
And just the usual reminder, this analysis was generated by an AI system. It's intended for educational purposes only. It is definitely not financial advice. Please always conduct your own thorough research or consult with a qualified financial advisor before making any investment decisions.